Before we begin, please remember that this video is for educational and informational purposes only and should not be considered financial advice. The information provided is general in nature. We are not financial advisors, and you should always consult with a qualified professional, like a financial advisor or mortgage specialist, before making any major financial decisions regarding your home, your assets, or your debt. There is a hidden multi-trillion-dollar treasure chest in the United States, and there's a very good chance that you own a piece of it. In fact, the average American homeowner is currently sitting on over $290,000 of it. $290,000. That's more than the cost of a new Ferrari, more than 4 years of tuition at Harvard, and for many people it's more money than they have in their entire retirement account. Yet, this incredible wealth isn't in stocks, it isn't in gold, and it isn't in some offshore bank account. It's locked inside the very walls of your house. It's called home equity. And the vast majority of people have absolutely no idea what it really is, how it works, or how to use it. You make that mortgage payment every single month, like clockwork. You see the money leave your bank account, but what are you actually building? Does it just feel like you're paying rent to the bank? What if I told you that every single one of those payments isn't just a cost? It's an investment. It's you systematically buying back your home from the bank one tiny piece at a time. And in the process, you are building what is arguably the single most powerful wealth creation tool available to the average American family. By the end of this presentation, you are going to understand this concept inside and out. We are going to demystify home equity completely. You will learn exactly what it is, the two powerful forces that make it grow, often while you sleep, and why it's the secret weapon you can use to potentially transform your financial life. We will break it all down into simple, easy-to-understand language. No confusing jargon, no complex formulas, just the straightforward information you need to understand the true value of the asset you live in. So let's start with the absolute basics. What is home equity? The simplest way to think about it is this: your house is a giant piggy bank. When you first buy it, the bank fills up most of that piggy bank. The money they lend you is their stake. The small amount you put in as a down payment? That's your stake. Home equity is simply the portion of the piggy bank that belongs to you. It's the current market value of your home, minus the amount you still owe the mortgage lender. That's it. It's the part you truly own, free and clear. If your home is worth $500,000 today, and you still have a mortgage balance of $300,000, your home equity is $200,000. It's that simple. It's not a theoretical number. It's the real, tangible value of your ownership. It's your net worth in your property. But here's where it gets truly exciting. This number isn't static. It's designed to grow, and it grows thanks to two incredibly powerful engines working in your favor. The first engine is the one you control directly. Let's call it the steady growth engine. This is your mortgage payment. Every month when you send that check to the bank, it gets split into two parts: interest and principal. The interest is the fee you pay the bank for the privilege of borrowing their money. That money is gone forever. It's their profit. But the principal portion? That's the magic part. The principal payment is you buying back a small piece of your home from the bank. It directly reduces the amount you owe. So if you owe $300,000 and your payment includes $1,000 of principal, next month you only owe $299,000. That $1,000 didn't just disappear. It was converted. It transformed from cash in your bank account into equity in your home. It instantly increased your ownership stake by $1,000. Over the course of a 30-year mortgage, you do this hundreds and hundreds of times. It's a slow, methodical, but incredibly reliable way to build wealth. You are forcing yourself to save and invest in a high-value asset every single month. But if your mortgage payment is the steady engine, the second engine is the turbocharger. This is the one that creates astonishing wealth, often with zero effort on your part. It's called appreciation. Appreciation is just a fancy word for your home's value increasing over time. This happens for all sorts of reasons: inflation, neighborhood improvements, a strong economy, or simply more people wanting to live in your area than there are houses available. Unlike paying down your principal, which is like adding dollars to your side of the scale one by one, appreciation is like a rising tide that lifts the entire value of your home. And here's the crucial part. When your home's value goes up, the bank doesn't get any of that gain. You do. 100% of it flows directly into your equity. Let's look at a quick example. Let's say you own that same $500,000 home with a $300,000 mortgage. Your equity is $200,000. Now imagine the local market has a good year. and your home's value increases by just 5%. That's a pretty conservative number in many parts of the US. Your home is now worth $525,000. Did your mortgage change? No. You still owe the bank $300,000. But what happened to your equity? It's now the new value, $525,000, minus your mortgage of $300,000. Your equity is now $225,000. You just made $25,000 in wealth, tax-free until you sell, simply by owning property in the right place at the right time. You did nothing. You didn't lift a finger. Your asset did the work for you. This is why homeownership is so powerful. You have two forces working in tandem. You are actively paying down your debt, while the underlying value of your asset is hopefully growing on its own. It's a financial double whammy. Let's put this all together in a real-world story. Meet Mark and Jessica. 5 years ago, they bought their first home for $400,000. They worked hard and saved up for a 20% down payment, which was $80,000. So, on day one, their mortgage loan was for $320,000, and their equity was exactly what they put in, $80,000. Now let's fast forward 5 years. For 60 straight months, they've been making their mortgage payments. Over that time, they've paid down about $25,000 of their principal balance. Their loan is now down to $295,000. So, just from their payments alone, their equity has grown from $80,000 to $105,000. That's solid, steady progress. But during those same 5 years, their neighborhood became much more desirable. New parks were built, a great new school opened up, and demand soared. Their home, which they bought for $400,000, is now appraised at $550,000. This is where the magic happens. Let's calculate their new equity. We take the new market value, $550,000, and subtract their remaining mortgage balance of $295,000. Their total home equity is now $255,000. Look at what just happened. In just 5 years, their initial $80,000 investment has more than tripled. It grew to over $250,000. Where did that growth come from? $25,000 came from their own hard work, dutifully paying the mortgage. But a staggering $150,000 came purely from market appreciation. It was wealth created out of thin air, simply because they owned the right asset. This is how normal, everyday people build generational wealth in America. Not through complicated stock trades or risky ventures, but through the simple act of owning the roof over their head. So now you understand what home equity is. It's the part of your home you own. And you understand the two engines that make it grow, your own payments and market appreciation. You can see how, over time, this can create a massive financial resource. You might even be sitting there right now, calculating your own equity in your head, realizing you're sitting on a much larger pile of wealth than you thought. But here is the most important question of all. So what? What good is this number on a piece of paper? How do you actually use it? How do you turn this theoretical wealth into a tool that can pay off high-interest credit cards, fund a college education, start a business, or finally build that dream kitchen? How do you tap into this private bank you've been building for years? That is where the strategy comes in, and that's where things get really powerful. So let's open the door to your private bank. Inside, you don't find stacks of cash. You find potential. You find opportunity. But like any bank, you can't just walk in and take what you want. You need the right key for the right vault. And when it comes to your home's equity, you have 3 master keys. Each one is designed for a different purpose, a different goal, a different kind of financial mission. Understanding which key to use, and when, is the difference between unlocking your dreams and accidentally locking yourself into a financial nightmare. The first key is the most straightforward. It's solid, dependable, and predictable. This is the home equity loan. Think of it as a one-time lump sum withdrawal from your bank. Let's say you've calculated that you need exactly $60,000 to completely remodel your 2 bathrooms and replace your ancient HVAC system. You've gotten the quotes, you know the number down to the penny. With a home equity loan, you apply for that $60,000. If you're approved, the bank cuts you a check for the full amount. Boom! The money is in your account, ready to go. Now this isn't a gift. It's a loan, a second mortgage, that you start paying back immediately in fixed monthly installments over a set period, maybe 10, 15, or 20 years. The single greatest advantage of this key is its predictability. The interest rate is almost always fixed. That means your payment will be the exact same amount on day one as it is on the very last day of the loan. There are no surprises. You can budget for it perfectly. You know the exact date this debt will be completely gone from your life. This is the financial equivalent of a surgeon's scalpel. Precise, effective for a specific, well-defined task. It's for the person who says, I need this amount of money for this one big thing, and I want to pay it off in a simple, predictable way. If you have a single, large, one-time expense, the home equity loan is your workhorse. It's the Fort Knox of equity access. Secure, simple, and solid. But what if your financial need isn't one big, single event? What if it's a series of events over time? What if you want to start a home renovation, but you know there will be unexpected costs? Or you need to pay for your child's college tuition, but you're paying it semester by semester over 4 years? For that, you need a different key. You need a key that offers flexibility. This is our second key. The home equity line of credit, or HELOC. This one is completely different. A HELOC doesn't give you a lump sum of cash. Instead, it opens up a line of credit like a credit card, but one that's secured by your house and comes with a much lower interest rate. Let's say you're approved for a $100,000 HELOC. That money doesn't just appear in your bank account. Sits there waiting. The bank gives you a special checkbook or a debit card linked to this credit line. Now you can draw from it as you need. That kitchen remodel you're planning? When the contractor needs a $10,000 deposit, you write a check from the HELOC. 2 months later, when the cabinets arrive, you pay the $20,000 bill from the HELOC. You only borrow what you need when you need it. And here's the crucial part. You only pay interest on the money you've actually used. If you have a $100,000 line of credit but have only drawn $30,000, you only owe interest on that $30,000. HELOCs typically have 2 phases. The first is the draw period, often 10 years, where you can take out money as needed. During this time, you're often only required to pay the interest on your balance, making the monthly payments incredibly low and manageable. After the draw period ends, the repayment period begins. You can no longer borrow money, and you start paying back both the principal and the interest, usually over the next 15 or 20 years. The big catch, the trade-off for all this amazing flexibility, is the interest rate. Unlike the fixed-rate home equity loan, HELOCs almost always have a variable interest rate. This means your rate is tied to a benchmark rate like the prime rate, and as that rate goes up or down, so does your interest payment. It offers incredible freedom, but it comes with the level of uncertainty that you must be prepared for. The HELOC is the financial Swiss Army knife. Versatile, adaptable, and perfect for ongoing projects or unpredictable expenses. So we have the simple lump sum loan and the flexible line of credit. But there is a third key. This one is the most powerful, the most transformative, but also the most complex. This is the cash-out refinance. This isn't just about taking a loan against your house. This is about replacing your entire existing mortgage with a new, larger one, and taking the difference in cash. Let's break that down. Imagine you bought your house years ago, and you have a $300,000 mortgage on it. Today, your house is worth $500,000, and you've paid your mortgage down to $200,000. So you have $300,000 in equity. Now let's also imagine that interest rates today are significantly lower than when you first got your mortgage. With a cash-out refinance, you could go to a lender and get a brand new mortgage for, say, $280,000. Here's what happens. That new loan of $280,000 is used to completely pay off your old $200,000 mortgage. The old loan is gone forever. The remaining $80,000? That's yours. It's wired to your bank account tax-free, to use for whatever you want. The beauty of this is that you've accessed $80,000 of your equity, but you still only have one single mortgage payment each month instead of a mortgage payment plus a separate home equity loan payment. And if you were able to secure a lower interest rate, it's possible your new larger mortgage payment could be very close to, or sometimes even less than what you were paying on your old smaller mortgage. This is the total reset button. It's a strategy for people who not only want to tap their equity, but also want to improve the terms of their primary loan. It's ideal for consolidating high-interest debt. You take that $80,000 in cash, pay off $20,000 in credit card debt and a $30,000 car loan, and you're left with $30,000 for home improvements, all while potentially lowering your overall mortgage interest rate. The downside? You are refinancing your entire mortgage, which means closing costs all over again, typically 2 to 5% of the new loan amount. And you are often resetting your loan clock, so if you're 10 years into a 30-year mortgage, a new 30-year mortgage means you'll be paying for a total of 40 years. So you have 3 keys. The home equity loan, a fixed, predictable lump sum for a specific project. The HELOC, a flexible, variable rate credit line for ongoing or uncertain expenses. and the cash-out refinance. A total mortgage replacement to get cash while also improving your loan's interest rate. Each one is a powerful tool, but a tool is only as good as the hands that wield it. Choosing the right one is critical, but it's only half the battle. Because what most people don't realize is that hidden within the paperwork for each of these options are tripwires, fees, clauses, and penalties designed to benefit the lender, not you. And there is one single critical question you absolutely must ask your loan officer before you sign any document. A question that can save you thousands of dollars and years of heartache. Getting the answer to that question is the real key to using your home's equity wisely. And that question is this: show me the amortization schedule for this loan, and tell me, in dollars and cents, the total amount of interest and fees I will have paid by month 60. Let me repeat that. Not the interest rate, not the APR. You want to see the amortization schedule. That's the table that shows exactly how each payment is broken down into principal and interest over the entire life of the loan. And you want the loan officer to circle two numbers for you: the total fees you'll pay at closing, and the total interest you will have paid after exactly 5 years. Why is this the magic question? Because it cuts through all the noise. Loan officers love to talk about low monthly payments and attractive introductory rates. They use percentages because percentages are abstract. They feel small. But asking for the total cost in dollars over a 5-year period, that's real. That's tangible. It forces them to put a hard number on the table that includes all the hidden costs: the origination fees, the appraisal fees, the underwriting fees, the title fees, all the little cuts that can add up to thousands of dollars before you've even made your first payment. 5 years is the key time frame because it's a realistic window. Within 5 years, you might move, you might refinance, or your financial situation might change dramatically. This question shows you the real front-loaded cost of the money you're borrowing. It prevents you from being seduced by a teaser rate that might explode later on. It's the difference between seeing the sticker price of a car and knowing the total cost of ownership after 5 years of gas, insurance, and maintenance. One is marketing, the other is reality. To see how this plays out, let's imagine two families. We'll call them the Parkers and the Millers. Both live in similar suburban homes. Both have been paying their mortgages diligently for a decade. And both have about $100,000 in home equity. Both families decide they want to renovate their dated kitchens, a project they estimate will cost around $50,000. The Millers go to a well-known bank that's flooding the airwaves with ads for a super low-rate home equity line of credit, or HELOC. They sit down with the friendly loan officer who pulls up a brochure. He points to the big, bold number: 2.99% introductory rate for the first year. The Millers are thrilled. That's lower than any credit card, lower than a personal loan. Feels like free money. They ask about the costs, and the loan officer waves his hand dismissively. Oh, just standard closing costs, a few $1,000s, we can even roll those into the loan for you. The Millers are so focused on that 2.99% rate, they don't press the issue. They sign the papers, and a few weeks later, they have access to a $75,000 line of credit tied to their home. Now let's look at the Parkers. They go to a local credit union. The loan officer there also presents them with a few options, including a similar HELOC with a variable rate. But the Parkers remember the critical question. Mrs. Parker looks the loan officer in the eye and says, "This looks interesting, but can you please show us the amortization schedule and tell us the total cost in dollars, including all fees and interest, that we would pay by month 60? The loan officer blinks. This isn't a question he gets every day. He can't just pull out a glossy brochure. He has to actually run the numbers. After a few minutes of typing, he prints out a sheet of paper. He shows them that with the HELOC, even though the initial rate is low, the variable nature means it could go up. More importantly, the upfront fees, the appraisal, the origination, the processing add up to $4,000. He then shows them a different product, a traditional fixed-rate home equity loan. The interest rate is a little higher at 5.5%, which at first sounds less appealing than 2.99%. But the closing costs are only $1,000, and the rate is fixed. It will never ever change. When he calculates the total cost over 5 years, the fixed-rate loan is actually cheaper, and, more importantly, it's predictable. There are no surprises. The Parkers choose the fixed-rate home equity loan. They get a check for exactly $50,000. What the Parkers and the Millers just experienced is the fundamental choice every homeowner has when they want to tap their equity. Do you want an installment loan? Or do you want a revolving line of credit? A home equity loan. What the Parkers chose is simple. Think of it like a car loan for your house. You borrow a specific amount of money one time in a lump sum. You then pay it back over a set period like 10, 15, or 20 years with a fixed interest rate. Your monthly payment is the exact same every single month until the loan is paid off. It's predictable, it's stable, and it's perfect for a single large planned expense, like a kitchen renovation. A home equity line of credit, or HELOC, which the Millers chose, is completely different. Think of it like a credit card that uses your house as collateral. You're not given a lump sum. Instead, you're approved for a maximum credit limit, say $75,000. You're given a special checkbook or a debit card, and you can borrow as much or as little as you want whenever you want up to that limit. You only pay interest on the amount you've actually borrowed. This is usually structured in 2 phases. The first is the draw period, typically 10 years. During this time, you can borrow and repay money freely, and your required monthly payments are often very low, sometimes interest only. After the draw period ends, the repayment period begins. Your credit line is frozen, and you have to start paying back the principal plus interest, usually over the next 15 or 20 years. Your payments will almost certainly go up, often dramatically. And here's the most important part. The interest rate on a HELOC is almost always variable. It's tied to a benchmark rate, usually the prime rate, which means when the Federal Reserve raises interest rates, your HELOC rate goes up too. So let's check back in with our 2 families 6 months later. The Parkers got their $50,000 check. They hired a contractor, built their dream kitchen, and it's beautiful. Their monthly payment is $495, and it will be $495 every month for the next 15 years. They know exactly when it will be paid off. The project is done, the debt is clear and defined, and they're building new memories in their new space. They used their home's value to increase their home's value. Now the Millers. They also finished their kitchen, and it also cost $50,000. But they still had $25,000 left in their HELOC. The access was just so easy. One afternoon, Mr. Miller is scrolling on his phone and sees a great lease deal on a new SUV. He thinks, we could use the HELOC for the down payment. The rate is so low. So they do. A few months later, they decide they deserve a vacation. A trip to Hawaii. Instead of saving up, they just write a check from the HELOC. Why not? Feels like they're just moving money around. But then the economy shifts. Inflation starts to rise. To combat it, the Federal Reserve begins to raise interest rates. The Millers get a letter in the mail. Their 2.99% introductory HELOC rate is over. The new variable rate is now 5.5%. A few months later, another rate hike. Now it's 7%, then 8.5%. Their minimum monthly payment, which was once so small and manageable, has now more than doubled. And it's still climbing. They are now paying an 8.5% interest rate on a kitchen remodel, a car that is losing value every day, and a vacation that is now just a distant memory. They use their home like an ATM for lifestyle purchases, and the bill is coming due in the most painful way possible. The easy money has become a lead weight, and the security of their home, the very foundation of their financial lives, is now at risk. They feel a pit in their stomach every time they open a letter from the bank, terrified to see how much higher their payment has gone. They thought they had a magic money tree, but they were really standing in financial quicksand. And the thing that's about to pull them under completely is a feature of all HELOCs that almost no one understands until it's far too late. It's called the end of the draw period, and for countless homeowners, it's a silent, ticking clock they don't even know is running. You see, a home equity line of credit isn't one continuous loan. It's a loan with 2 completely different lives. 2 phases. The first phase is the one everyone loves. It's the one the bank advertises. It's called the draw period. This typically lasts for 10 years. During this time, your HELOC acts like a magical credit card secured by your house. You can borrow money, pay it back, and borrow it again up to your credit limit. You have incredible flexibility. And here's the seductive part. During this draw period, many lenders only require you to pay the interest on the money you've borrowed. Think about Mark and Sarah. They had a $100,000 balance on their HELOC. With an interest rate of, say, 6%, their minimum monthly payment was only the interest. That's $500 a month. For them, that felt manageable. They could handle $500. They saw it on their statement, paid it, and didn't think twice. They were living in the honeymoon phase of their loan. What they didn't realize, what was buried on page 17 of their loan agreement, was that this honeymoon had an expiration date. After 10 years, the draw period ends. The clock strikes midnight, and the HELOC transforms into something completely different. This is the start of phase 2. the repayment period. And when this happens, two massive things change instantly. First, your line of credit is frozen. The credit card is cut up. You cannot borrow one more single dollar from it, ever. The open tab is closed. Second, and this is the part that brings families to their knees, your payment structure completely changes. You are no longer allowed to just pay the interest. Now, the bank takes your entire outstanding balance, for Mark and Sarah that's $100,000, and they turn it into a traditional loan. You have to pay back that entire principal plus interest over the remaining term of the loan, which is usually 15 or 20 years. This is the moment of payment shock. Let's go back to Mark and Sarah and their $500 interest-only payment. The 10-year mark hits. Their draw period is over. Now, their $100,000 balance is converted into a 20-year repayment plan. Even if their interest rate magically stayed the same at 6%, their new monthly payment, which now includes principal, would jump from $500 to $716. That's a 43% increase overnight. Suddenly, their budget is short over $200 every single month. That's a car payment. That's a full week of groceries. It's a painful adjustment, but maybe, just maybe, they could survive it by cutting back everywhere else. But here's the truly devastating twist. HELOCs almost always have a variable interest rate. During the 10-year draw period, the rate can go up or down with the market. Mark and Sarah got their HELOC when rates were low. But over a decade, a lot can change in the economy. By the time their repayment period began, the prime rate had gone up significantly. Their new interest rate wasn't 6% anymore. It was 9%. So now let's rerun the numbers. A $100,000 balance, to be paid off over 20 years, at 9% interest. Their new monthly payment isn't $500. It isn't even $716. It's $899. Almost $900 a month. Their payment has nearly doubled from one month to the next, with absolutely no warning they paid attention to. This is the financial quicksand. The $500 payment was an illusion. It was a temporary introductory offer that lasted a decade. It lulled them into a false sense of security, making them believe they could afford a lifestyle that was funded by debt. Now reality is hitting them like a freight train. The extra $400 a month simply doesn't exist in their budget. They're forced to choose between their mortgage and their kids' activities, between keeping the lights on and paying for car repairs. The stress is immense. The arguments start. The home they thought was a source of wealth has become the source of their misery. And the worst part? It was all perfectly legal. It was all in the contract they signed 10 years ago. They just didn't understand what they were signing. The loan officer probably glossed over it, focusing on the low monthly payments and the flexible access to cash. And why wouldn't they? That's the easy sell. Nobody wants to lead a sales pitch by talking about what will happen a decade in the future. This story isn't an exaggeration. Hundreds of thousands of American homeowners who took out HELOCs in the low interest rate environment of the early 2010s are hitting the end of their draw periods right now. They are experiencing this exact payment shock, and it is financially crippling them. They treated their equity like an ATM, and they've just discovered the service fees are bigger than the original withdrawal. So the HELOC, this incredibly popular and flexible tool, has a dark side. It has a built-in time bomb. Its flexibility is its greatest strength during the draw period, but that same flexibility, combined with a variable interest rate and the shift to the repayment period, becomes its most dangerous weakness. This begs the question, is there a safer, more predictable way to tap into your home's equity? What if you need a specific amount of money for a big one-time expense, like a major home renovation or consolidating high-interest debt? You don't need the ongoing temptation of a line of credit. You need stability. You need to know with 100% certainty what your payment will be next month, next year, and 10 years from now. Well, there is another option. It's the HELOC's less flashy, more dependable older sibling. It's known simply as a home equity loan. Unlike the HELOC, which is a revolving line of credit, a home equity loan is what's called an installment loan. It works much more like your primary mortgage or a car loan. You borrow a single lump sum of money one time. If you're approved for a $75,000 home equity loan, you get a check or a wire transfer for $75,000. That's it. The vault is closed. You can't go back for more. And from that moment on, you begin paying it back in regular, fixed monthly payments over a set period of time, say 15 or 30 years. The biggest difference, and the most important feature, is that home equity loans almost always have a fixed interest rate. The rate you get on day one is the rate you will have for the entire life of the loan. It will never change. It doesn't matter if market interest rates shoot to the moon. Your payment is locked in. It is predictable. It is stable. There is no draw period. There is no repayment period. There is no payment shock. There is only one single consistent phase. You borrow the money, and you pay it back with the same exact payment every single month until it's gone. For someone like Mark and Sarah, if they had known the difference, this could have changed everything. Let's imagine they still needed that $100,000 for their renovation and business. If they had taken out a 30-year home equity loan at a fixed rate of 6%, their payment from the very first month would have been about $600. Yes, that's $100 more per month than the initial interest-only HELOC payment. And maybe at the time that extra $100 seemed like a big deal. They might have chosen the HELOC specifically to get that lower initial payment. But that $600 payment would never have changed. It would have been the same amount on their very first statement and their very last. They could have budgeted for it with confidence. There would be no ticking clock, no variable rate anxiety, no catastrophic payment shock waiting for them a decade down the road. They would have traded a little bit of short-term flexibility for a massive amount of long-term security. So we have two powerful tools, both fueled by your home's equity. One is a financial Swiss Army knife. Flexible, versatile, but with a hidden blade that can cut you badly if you're not careful. The other is a simple, solid hammer, predictable, reliable, and designed for one specific job. One gives you a decade of deceptively low payments. The other gives you decades of absolute certainty. One is a financial tool. The other can be a financial time bomb, and the difference between them is everything. So how do you choose the safe path? How do you know which tool is right for your specific job? Well, it starts by understanding the other side of the coin, the predictable, stable, and often overlooked option that banks are sometimes less excited to tell you about. This less hyped workhorse of the financial world is the home equity loan. And if a HELOC is like a financial Swiss Army knife, flexible with lots of little tools for different situations, then a home equity loan is like a perfectly weighted sledgehammer. It's designed for one big job, and it does that job with incredible predictable force. Let's get rid of the jargon for a moment. A home equity loan is often called a second mortgage. That's really all it is. You borrow a specific fixed amount of money against the equity you've built in your home, and you receive that money all at once in a single lump sum. A check for $50,000. A wire transfer for $75,000. It's yours. From that moment on, you have a new loan with a fixed interest rate and a fixed monthly payment for a fixed period of time, usually somewhere between 5 and 20 years. The key words there are fixed, fixed, fixed. Nothing changes. Your payment on day one is the exact same as your payment in year 10. The interest rate you lock in at the start is the rate you have until the loan is paid off. This is the polar opposite of the variable rate HELOC we talked about, where your payments can feel like they're tied to the whims of the global economy. With a home equity loan, you are building a fortress of predictability around your finances. Let's imagine a family, the Jacksons. They've been in their home for a decade. They've paid their mortgage diligently, and the property value in their neighborhood has climbed steadily. They have about $100,000 in equity, and their dream is to finally build that backyard deck and patio they've been sketching on napkins for years. They get a contractor and the quote comes in $40,000. It's a big number, but it's a specific number. They know exactly what they need. The Jacksons could get a HELOC. They could open a line of credit for, say, $80,000. But they don't need a line of credit. They don't need the temptation to tap into it for a vacation next year or a new car the year after. They need $40,000. Now, for one project. So they opt for the home equity loan. They go to their lender, prove their income, their credit is solid, and they have the equity to back it up. They are approved for a $40,000 loan. A few weeks later, a check for $40,000 arrives. They pay the contractor, the deck gets built, and for the next 15 years they have a monthly payment of, let's say, $380. Every single month. It doesn't matter if the Federal Reserve raises interest rates 5 times. It doesn't matter if the stock market goes on a roller coaster ride. Their payment is $380. They can budget for it. They can plan around it. There are no surprises. This is the profound, almost boring beauty of the home equity loan. It's for the planners, the people who want to eliminate variables. It's for the person who says, I need to consolidate 10 different high-interest credit card debts into one single, manageable payment with a lower interest rate. They can calculate the exact amount they need to pay off their cards, take out a home equity loan for that amount, and immediately slash their interest costs while simplifying their life down to one predictable payment. It's for the parents who are looking at a tuition bill for their child's freshman year of college. They know the cost is $30,000. They take out a loan for that amount, pay the university, and they know exactly what their financial commitment is for the life of that loan. So if this option is so stable and straightforward, why is it sometimes the second or third thing a bank brings up? Why do they often lead with the HELOC? Well, think about it from their perspective. A variable rate HELOC is an asset that adjusts with the market. If interest rates across the country go up, the rate on your HELOC goes up, and the bank makes more money. It's a product that protects the bank from inflation and rising rates. A fixed-rate home equity loan, on the other hand, is a gamble for them. If they give you a loan at 7% and 5 years from now, prevailing rates are 11%, they're stuck earning 7% on your loan. They've essentially lost out on potential profit. By locking in your rate, you are transferring the risk of rising interest rates from yourself to the bank. And that's a powerful position to be in. Of course, the sledgehammer isn't the right tool for every job. The home equity loan has its own set of distinct disadvantages you have to weigh. First, there's the lack of flexibility. That lump sum is a one-and-done deal. If the Jackson's Deck project suddenly has an unforeseen issue and the cost jumps to $45,000, they can't just draw more money. Their loan was for $40,000 and that's all they get. They'd have to find that extra $5,000 somewhere else. With a HELOC, they could have just drawn more from their available credit line. Second, home equity loans typically come with closing costs just like your original mortgage. These can be anywhere from 2% to 5% of the loan amount. You'll see fees for appraisals, origination, title searches, and more. On a $40,000 loan, that could be $2,000 right off the top, which is either paid out of pocket or rolled into the loan itself, meaning you're paying interest on it. Some HELOCs, by contrast, are advertised with no closing costs, making them cheaper to set up initially. And finally, and this cannot be stressed enough, just like a HELOC, this is a loan secured by your house. The term second mortgage isn't just a nickname. It's a legal reality. You now have two liens on your property. If you fail to make the payments on your home equity loan, the lender can initiate foreclosure proceedings, even if you are perfectly current on your primary mortgage. You are putting the roof over your head on the line. That's the fundamental trade-off for getting access to this wealth at a relatively low interest rate. The stakes are as high as they get. So we have two powerful tools, each with a completely different philosophy. The HELOC, a flexible, adaptable line of credit, perfect for ongoing projects or as a financial safety net, but often coming with the uncertainty of a variable interest rate. And the home equity loan, a stable, predictable lump sum of cash, perfect for large, one-time expenses, but with no flexibility once the money is in your hands. One is a scalpel, the other is a sledgehammer. One is for a series of small, unknown cuts. The other is for one big, calculated strike. Choosing the right one is critical, but there's another layer to this. Knowing which tool you want is one thing. Being allowed to use it is another. What do the banks actually see when they look at you? What numbers, what ratios, what red flags are they searching for in your financial life that determine not just if you get approved, but for how much and at what interest rate? Understanding their criteria is the key to unlocking the vault. The first number they look at, the very first filter your application passes through, isn't your income. It isn't your assets. It's a 3-digit number that tells a story about your past promises. I'm talking, of course, about your credit score. Think of your credit score not as a grade but as a measure of trust. To a lender, it's a financial handshake. A score above 740 is a firm, confident grip. It says, I have a long history of borrowing money and paying it back on time every time. I am a reliable partner. A score between 680 and 740 is a pretty good handshake. It says, I'm responsible, maybe with a shorter history or a minor slip-up years ago, but I'm a solid bet. But once you dip below 680, that handshake starts to get a little weaker in their eyes. The grip isn't as firm. They might see a history of late payments, high credit card balances, or other signs that you might be overextended. Now, why does this one number hold so much power? Because it directly translates into risk, and risk translates into cost. For the lender, a lower credit score means a higher risk that you might default on the loan. To compensate for that increased risk, they do one of two things: they either charge you a much higher interest rate, or they deny the loan altogether. The difference is staggering. Someone with a 760 score might get a HELOC at a prime rate, let's say 8.5%. Someone with a 660 score, applying for the exact same loan on the exact same day, might be offered a rate of 11% or 12%, if they're approved at all. Over the life of a substantial loan, that 3 or 4% difference isn't just a few bucks. It's tens of thousands of dollars in extra interest payments. Your credit score is the gatekeeper. It determines whether you get the VIP pass to the best rates, or if you're stuck outside hoping to get in. But passing the gatekeeper is only the first step. Once you're inside, they subject you to a financial stress test. This is the second and arguably the most misunderstood pillar of their decision, your debt-to-income ratio or DTI. This is where your income finally comes into play, but not in the way most people think. The lender doesn't just care about how much money you make. They care about how much of that money is already spoken for before you even get your hands on it. Imagine your monthly income is a bucket of water. Every month, a certain amount of water pours in, but your bucket has some holes in it. One hole is your mortgage payment. Another is your car payment. Another is your student loan payment. Then you have minimum payments on your credit cards. DTI is simply the measure of how much water is leaking out of your bucket through those debt holes, compared to how much water is pouring in. The formula is simple. They take all your monthly debt payments, and that includes your estimated new payment for the home equity loan you're applying for, and they divide it by your gross monthly income, the amount you make before taxes. The result is a percentage, and that percentage tells them how much financial pressure you're under. Lenders have a magic number here, and it's generally 43%. If more than 43% of your pre-tax income is going toward debt payments, red flags start waving all over their office. For them, that's a sign that you have very little wiggle room. One unexpected car repair, one medical bill, one period of reduced income, and you could be in serious trouble, potentially unable to pay them back. Ideally, they want to see a DTI under 36%. That's the gold standard. It tells them you have a healthy buffer, a financial cushion to absorb life's surprises. This is the great equalizer. You could earn $300,000 a year, but if you have 2 luxury car payments, a huge mortgage, and hefty student loans, your DTI could easily be over 50%. Meanwhile, someone earning $80,000 a year with a modest mortgage and no other debt might have a DTI of 25%. In the lender's eyes, that second person is a much safer bet. DTI isn't about being rich, it's about living within your means, and they have a very specific definition of what that means. So, you've passed the credit score gatekeeper, you've aced the DTI stress test. Now comes the final, most important piece of the puzzle, the one that's directly tied to your home itself. This is the loan-to-value ratio, or LTV. If your credit score is about your past promises, and your DTI is about your present ability to pay, then your LTV is all about the lender's future security. It's their insurance policy. It's their answer to the question, what happens if everything goes wrong? LTV measures the total amount of debt secured by your property against the property's actual appraised value. Lenders almost never, ever let you borrow 100% of your home's equity. Why? Because the housing market can be volatile. Home values can go down. If they lend you every last penny of your equity and the market takes a dip, your home could suddenly be worth less than the total amount you owe on it. That puts both you and the lender in a terrible position. To protect themselves, they insist on leaving a protective cushion of equity in the home. Typically, they will not let your total debt, your primary mortgage plus your new home equity loan or line of credit, exceed 80% or 85% of your home's appraised value. This is called the combined loan-to-value, or CLTV. Let's put this into simple numbers because this is the calculation that determines your borrowing power. Let's say your home is appraised at $500,000. And let's say your lender's maximum allowed CLTV is 80%. You take your home value, $500,000, and multiply it by 80%, which gives you $400,000. This is the absolute maximum amount of debt they are willing to have on this property. Now, you look at your current mortgage balance. Let's say you still owe $250,000. To find out how much equity you can tap, you simply subtract your current mortgage from that maximum debt amount. So, $400,000 minus $250,000 equals $150,000. That $150,000 is the maximum amount of money they will lend you. It's not the full $250,000 of equity you technically have. It's the amount that keeps their risk within a comfortable limit, maintaining that critical 20% equity cushion. These 3 pillars, credit score, DTI, and LTV, form the lender's trinity. They don't look at just one. They look at how all 3 work together to paint a complete picture of you as a borrower. You could have a perfect 850 credit score, but if your DTI is 55%, you'll likely be denied. You could have a fantastic DTI and a huge amount of equity, but a 580 credit score will stop the application in its tracks. They are all non-negotiable hurdles you have to clear. And beyond these big three, they'll also glance at your employment history for stability and your bank accounts for cash reserves, just to be sure you aren't living on the edge. They want to see a steady, predictable financial life. So now you know the test the lender is going to give you. You know the questions on the exam. The next most critical step is learning how to study for it. How do you actively, strategically, and sometimes surprisingly quickly boost those numbers to not just pass the test but to ace it and walk away with the best possible deal? That's where the real power lies. Let's break down the syllabus for this financial final exam. There are two major subjects you need to master: your credit score and your debt-to-income ratio. Think of them as the math and science of your financial life. Get an A in both, and you're in the honor society of borrowing. First, let's tackle the biggest beast: your credit score. This three-digit number is your financial grade point average. It tells lenders in a single glance how responsible you are with other people's money. And the formula they use isn't a secret. It's heavily weighted, so you need to know where to focus your study time. 35% of your entire score, the single biggest chunk, is based on your payment history. That's it. Do you pay your bills on time? Every single time? This is the pass/fail part of the course. One late payment can be catastrophic, dropping your score by 50, 80, even 100 points, and that black mark can stay on your record for 7 years. So, the number one non-negotiable strategy is to automate everything. Set up autopay for the minimum amount due on every single credit card, car loan, and student loan you have. No exceptions. This is your safety net. You can always go in and pay more manually, but this ensures you will never ever be late because you forgot. But what if the damage is already done? What if you have a late payment from 6 months or a year ago staring at you on your report? You have one shot. It's called a goodwill letter. You literally write a polite, professional letter to the creditor, explain the situation that caused the late payment, maybe a medical emergency or a technical glitch, emphasize your otherwise stellar payment history, and humbly ask for a goodwill adjustment to remove the late mark from your credit report. It is a total long shot. They have no obligation to do it. But for the cost of a stamp or the time to find the right email address, you have a chance to erase a massive anchor weighing down your score. Okay, next subject, worth a whopping 30% of your grade: credit utilization. This sounds complicated, but it's dead simple. It's the amount of credit card debt you have compared to your total credit limit. If you have one credit card with a $10,000 limit and a $3,000 balance, your utilization is 30%. This is the magic number. Lenders see anything over 30% as a sign of financial stress. They start to get nervous. To ace this part of the test, you want to be under 10%. Getting from 30% to under 10% can rocket your score up. So how do you do it? The obvious way is to pay down your balances. Throw every extra dollar you can at your credit card debt, starting with the card that has the highest utilization percentage. But there's a less obvious and sometimes faster way. You can call your credit card company and ask for a credit limit increase. If they raise your limit from $10,000 to $20,000, that $3,000 balance suddenly goes from 30% utilization down to just 15%. Your score goes up and you didn't have to pay an extra dime. A quick warning: when you call, specifically ask if the request will result in a soft pull or a hard pull on your credit. A soft pull is harmless. A hard pull is a formal credit application that can temporarily ding your score, which is what we're trying to avoid. Most major banks will do a soft pull for existing customers. The remaining 35% of your score is a mix of other factors. 15% is the length of your credit history. The strategy here is simple. Do nothing. Do not close your oldest credit cards, even if you don't use them. That old card you got in college with a tiny limit is one of your most valuable assets. It's anchoring your average age of accounts. Keep it open, use it for a tiny purchase once every 6 months to keep it active, and pay it off immediately. The other two factors, credit mix and new credit, are each worth 10%. Credit mix just means lenders like to see you can handle both revolving debt like credit cards and installment debt like a car loan. And new credit is about how many times you've recently applied for a loan. The takeaway is this: in the 6 to 12 months before you plan to tap your home equity, go on a credit diet. Don't apply for any new store cards, car loans, or anything else that triggers a hard inquiry. Just focus on optimizing the accounts you already have. Now for the second major subject on the exam: your debt-to-income ratio, or DTI. If your credit score is your GPA, your DTI is your attendance record. It shows the lender if you're even capable of showing up and handling another payment. They calculate it by taking all your monthly debt payments, your mortgage, car loans, student loans, minimum credit card payments, and dividing that total by your gross monthly income, the money you make before taxes. For example, if your mortgage is $2,000, your car payment is $500, and your student loans are $300, that's $2,800 in monthly debt. If your gross monthly income is $8,000, your DTI is 35%. Most lenders want to see a DTI of 43% or less to even consider you for a home equity product. To get the best rates, you want to be well under that, ideally in the low 30s or even the 20s. There are only two levers you can pull to improve your DTI. Decrease your debt or increase your income. Let's start with the debt lever. This is where you have the most direct control. You need an aggressive plan to pay down your non-mortgage debt. Two popular methods are the snowball and the avalanche. The debt snowball is about psychology. You list all your debts from smallest balance to largest, regardless of interest rate. You make minimum payments on everything, but you throw every extra penny at the smallest debt until it's gone. That quick win gives you a huge motivational boost. You then take the money you were paying on that debt and roll it into the next smallest one. The momentum builds and you feel like you're winning. The debt avalanche is pure math. You list your debts from the highest interest rate to the lowest. You attack the highest interest debt first, usually a credit card, because it's costing you the most money. Once it's paid off, you roll that payment into the next highest interest debt. It might take longer to get your first win, but you will pay less in total interest over time. Which one is better? The one you'll actually stick with. The second lever is increasing your income. This is often harder, but it's incredibly powerful. This could mean taking on a side hustle, negotiating a raise at your current job, or making sure you properly document all your income for the lender. If you get bonuses, commissions, or have freelance income, gather the paperwork to prove that it's stable and consistent. A lender might not count a one-time bonus, but if you can show you've received a similar bonus for the past 2 years, it suddenly becomes part of your income calculation, which can dramatically lower your DTI. Finally, let's talk about extra credit. These are the things that aren't officially on the test but that the teacher, the loan underwriter, absolutely loves to see. First, cash reserves. Do you have an emergency fund? Lenders get very comfortable when they see you have 3 to 6 months worth of living expenses sitting in a savings account. It shows them you're not one paycheck away from disaster, and that you won't be using the home equity line for a desperate bailout. Second, employment stability. Lenders want to see that you've been at the same job, or at least in the same industry, for at least 2 years. Avoid changing jobs right before you apply if you can help it. By strategically focusing on these key areas, crushing your payment history, lowering your credit utilization, paying down high-interest debt, and documenting your income, you're not just preparing to apply for a loan. You're transforming your entire financial profile. You're moving from a position of asking for a loan to one where lenders are competing for your business. So you've studied, you've aced the test, and your financial report card is sparkling. Now what? Now it's time to actually walk into the marketplace and start shopping. But this isn't like buying groceries. The shelves are filled with complex products, confusing terms, and hidden fees. How do you compare a fixed-rate home equity loan from a big national bank to a variable-rate HELOC from your local credit union? What are the key questions you must ask to avoid getting trapped in a bad deal? That's where we go next. Navigating the real world of lenders and loan offers. You're standing at a crossroads. On one side, there's the massive marble-column national bank where you have your checking account. On the other, the friendly local credit union with a sign for a community bake sale in the window. And then there are the dozens of online lenders flooding your social media feeds, all promising lightning-fast approvals and rock-bottom rates. This isn't just a choice. It's a strategic decision that can save you, or cost you, tens of thousands of dollars over the life of your loan. Choosing the right lender is just as important as choosing the right type of loan. Let's break down the players on the field. First, you have the big national banks, the household names. The appeal here is convenience and integration. They already have your financial information. You can see your home equity loan right next to your checking account on their app, and their technology is usually slick and polished. But this convenience can come at a cost. Big banks are massive institutions. They often have rigid, standardized underwriting criteria. If your financial picture has a single smudge on it, maybe you're self-employed or your credit score isn't quite stellar, their algorithm might just say no without a human ever looking at the details. Their rates can also be less competitive, because they're banking on you choosing what's easy over what's best. Next, you have local and regional banks. These can be a fantastic middle ground. They have more resources and branches than a small credit union, but they still have a connection to the local community. The loan officer you speak with might actually live in your town. They often have a bit more flexibility in their underwriting because they understand the local housing market intimately. They're a solid option to have on your comparison list, offering a blend of personal service and big bank capabilities. Then we have the credit unions. And this is where things get interesting. Credit unions are nonprofit financial cooperatives. That means they are owned by their members, people like you, not by stockholders. Their primary mission isn't to maximize profit for Wall Street. It's to provide value back to their members. Because of this structure, credit unions often offer some of the most competitive interest rates and lowest fees on the market for both home equity loans and HELOCs. They are also renowned for their personal service and more holistic approach to underwriting. If you have a slightly unconventional financial situation, a credit union is far more likely to sit down, listen to your story, and try to find a way to make it work. The trade-offs? You have to be eligible for membership, which might be based on where you live, where you work, or your affiliation with a certain group. And their technology might not be as cutting edge as the big national players. Finally, there's the new wave of online lenders and fintech companies. Their entire model is built on speed and a frictionless digital experience. You can often get pre-approved in minutes from your couch, upload documents from your phone, and close the entire loan without ever speaking to a human being. For someone who is tech-savvy and has a straightforward financial profile, this can be incredibly appealing. But you have to be careful. The ultra-convenient interface can sometimes hide less than favorable terms, or a sea of hidden fees in the fine print. And if something goes wrong, your customer service might be a chatbot or a call center thousands of miles away. You're trading personal guidance for digital efficiency. So how do you choose? You don't. Not at first. You make them compete for your business. You should be getting quotes from at least 3 different types of lenders. One big bank, one credit union, and one online lender, for example. But getting a quote is useless unless you know the right questions to ask. An offer that looks good on the surface can be a financial trap in disguise. So, pull out a notepad because these are the 5 non-negotiable questions you must ask every single lender you speak to. Question number 1, and it's the most important. What is the annual percentage rate, the APR? Do not get distracted by the advertised interest rate. The interest rate is just the cost of borrowing the money. The APR is the true cost of the loan. It includes the interest rate plus most of the fees, the origination fees, points, and other charges, all rolled into a single standardized number. Think of it like this. The interest rate is the sticker price of a car. The APR is the out-the-door price after they've added in all the dealer fees, destination charges, and document prep fees. 2 loans can have the exact same interest rate, but wildly different APRs. The loan with the lower APR is the cheaper loan. Period. Always compare APR to APR. Question number 2. Can you please provide me with an itemized list of every single closing cost and fee? Don't accept a vague answer like, "Oh, it's usually a couple $1,000s." Make them list it out. You're looking for things like the origination fee, which is a percentage of the loan amount the lender charges for processing it, the appraisal fee, title search and insurance fees, attorney or closing fees, and most importantly, you need to ask a follow-up question. Does this loan have a prepayment penalty? A prepayment penalty is a nasty clause that says if you pay the loan off early, maybe you sell the house or refinance, you have to pay the bank an extra fee. It's a trap designed to keep you locked into their loan. A reputable lender in today's market should not be charging a prepayment penalty on a home equity product. If they do, it's a giant red flag. Question number 3, and this is critical for HELOCs. Is this interest rate fixed or variable? And if it's variable, what is the formula? A fixed-rate home equity loan is simple. The rate is locked for the life of the loan. But a HELOC is almost always variable. You need to become a detective. Ask, what index is the rate tied to? Usually it's the US prime rate. Then ask, what is the margin? The lender adds a margin to the index to determine your rate. So if the prime rate is 8.5% and your margin is 1%, your rate is 9.5%. The margin is your key comparison point between lenders. Next, the most important part. What are the rate caps? There should be a periodic cap, how much the rate can increase in a given year, and a lifetime cap, which is the absolute maximum the rate can ever reach. If a lender can't give you clear, confident answers on the index, the margin, and the caps, you should walk away. They are selling you a product defined by uncertainty, and that's a risk you can't afford to take. Question number 4, also for HELOCs. What are the exact terms of the draw period and the repayment period? A HELOC is a 2-act play. The first act is the draw period, typically 10 years, where you can borrow and repay money as you like, often only paying the interest on your balance. But then the curtain falls and the second act begins, the repayment period. The credit line freezes and you must start paying back both the principal and the interest, usually over 10 or 20 years. This transition can cause a massive payment shock. Your monthly payment could easily double or triple overnight. You need to know exactly when that happens and what the new payment will be based on. Ask the lender to run a sample amortization schedule for you so you can see what your fully amortized payment would look like if you maxed out your line. And the 5th and final question: what happens if I run into financial trouble? This is the question that reveals the character of the institution you're about to partner with. Ask them about their policies on forbearance, loan modifications, or hardship programs. A good lender will have clear, supportive processes in place. A predatory one will be vague or dismissive. You are borrowing against your home. You need to know that if life throws you a curveball, a job loss, a medical emergency, the institution on the other side of that loan will work with you, not against you. Imagine 2 neighbors, both getting a $100,000 HELOC. Dave goes with his big national bank because it's easy. He clicks a few buttons, signs the papers, and never asks the hard questions. Sarah talks to that same bank, a local credit union, and an online lender. She gets the APRs, she gets the fee sheets, she understands the variable rate caps and the repayment terms. She discovers the credit union's APR is a full half point lower, saving her thousands. She confirms there's no prepayment penalty, unlike the online offer. She chooses the credit union not because it was the easiest, but because it was the smartest. That's the power you have. You are the one in control, but only if you're armed with the right questions. So you've shopped around, you've grilled the lenders, you've compared the APRs and the fine print, and you've selected the loan and the lender that are the absolute best fit for you. You're ready. Now comes the moment of truth, the formal application and the underwriting process. What documents do you need to have ready to go? What is that mysterious underwriter in a back room actually looking for in your file? And what are the common last-minute mistakes that can get an otherwise perfect application denied? That's what we're breaking down next. All right, let's pull back the curtain on the entire home equity application process, from the first piece of paper to the final approval. Think of this not as a scary bureaucratic nightmare, but as an open book test. If you have the right answers ready, you're going to pass. The lender and the underwriter aren't actively trying to deny you. Their job is to verify that you're a good risk. Your job is to make their decision as easy as possible by building a bulletproof case. First, let's talk about the documents you'll need to assemble. This is your arsenal. The more organized you are here, the smoother everything else goes. You're going to need your most recent pay stubs, typically for the last 30 days. This proves your current income. Next, grab your W-2 forms from the last 2 years. While pay stubs show a snapshot, W-2s tell the story of your income over time, showing stability. If you're self-employed or have variable income, get ready with your last 2 years of federal tax returns, all pages. They'll be looking at your net income after write-offs, not your gross revenue, so be prepared for that. Then you'll need bank statements, usually the last 2 months for all your accounts, checking, savings, any investment accounts. And here's a pro tip. The lender isn't just looking at your balance. They're scanning for large, unusual deposits. A $50,000 deposit that appeared out of nowhere a week ago is a huge red flag. To them, that could be an undisclosed loan from a family member that you'll have to pay back, which affects your ability to repay them. If you have legitimate large deposits like a work bonus or an inheritance, be ready with the paperwork to prove its source. You'll also need a copy of your most recent mortgage statement for any and all properties you own. This verifies your current loan balance, which they need for the LTV calculation. And finally, you'll need your homeowner's insurance declaration page. This proves you have the required insurance on the property that's acting as collateral. Get all of this into a single digital folder. When the lender asks for it, you'll be able to send it over in minutes, which instantly makes you look like a responsible, organized borrower. Now let's talk about that mysterious underwriter. The underwriter is the final decision maker. They are the person who meticulously goes through your file to ensure it meets the lender's guidelines and doesn't pose an unreasonable risk. To understand what they're looking for, you just need to remember the 3 C's of credit: character, capacity, and collateral. First is character, which is really just a formal way of talking about your credit history and score. They want to see a long history of you borrowing money and paying it back on time. Your FICO score is the key metric here. While requirements vary, most lenders are looking for a score of 680 or higher for a home equity loan or HELOC. A score above 740 will put you in the top tier and get you the best interest rates. The underwriter will look at your full credit report, not just the score. They'll look for things like bankruptcies, foreclosures, or a high number of recent credit inquiries, which can suggest you're desperately seeking credit. Second is capacity. This is your ability to repay the loan. The single most important calculation here is your debt-to-income ratio, or DTI. It's simple math. They add up all your monthly debt payments, your mortgage, car loans, student loans, credit card minimums, and divide it by your gross monthly income. For example, if your total monthly debts are $3,000 and your gross monthly income is $8,000, your DTI is 37.5%. Most lenders want to see a DTI of 43% or less. Some might go up to 50% if you have a high credit score and significant savings, but 43% is the magic number to aim for. The underwriter is stress testing your budget. They're asking, if we add this new home equity payment, can this person still comfortably live and handle their other obligations? The third C is collateral. This is your house. The lender is securing the loan with your property, so they need to be absolutely sure of its value. This is where the home appraisal comes in. The lender will order an independent appraisal of your home. An appraiser will come out, inspect your property, measure it, take photos, and compare it to recently sold homes in your neighborhood, the famous comps. The value they determine is critical. If you think your home is worth $500,000 but the appraisal comes in at $450,000, that dramatically changes your LTV and the amount of equity you can borrow against. A low appraisal is one of the most common reasons a home equity loan gets reduced or even denied at this stage. So you've gathered your documents and your numbers look good on paper. You're in the home stretch. This is where people make the costliest mistakes. You must treat the entire period from application to closing as a financial quiet period. Do not make any sudden moves. Here are the absolute deal killers that can get a perfect application denied at the 11th hour. Number 1, don't change jobs. Lenders prize stability above almost all else. Even if you're moving to a higher paying job, a change can derail your application. The underwriter has verified your employment and income with your current employer. A new job, especially if it changes your pay structure from salary to commission, introduces a new risk. If you absolutely have to change jobs, talk to your loan officer immediately. But the best advice is to wait until after the loan has closed. Number 2, don't buy a car or make any other major purchases on credit. When you apply for that new car loan, the lender does a hard pull on your credit, which can ding your score. More importantly, you've just added a new $600 monthly payment. This completely changes your DTI ratio. The DTI that got you approved is now wrong, and the underwriter will have to recalculate. That new car could be the very thing that pushes your DTI over the 43% threshold and turns an approval into a denial. This also goes for co-signing a loan for someone else. In the lender's eyes, that is your debt. Number 3, don't move money around inexplicably. As we mentioned, underwriters scrutinize bank statements. Don't suddenly deposit a large amount of cash that you can't document. It looks like you're trying to hide an undeclared loan. Also, don't move money between accounts without a clear paper trail. Keep things clean and simple until the loan is funded. Number 4, don't miss a payment on any of your existing debts. This seems obvious, but it happens. People get focused on the new loan and forget a credit card due date. That late payment will hit your credit report, drop your score, and send a massive red flag to the underwriter right before closing. Set everything to auto-pay. And finally, number 5, be responsive. Your loan officer or processor will likely come back to you with questions from the underwriter. They might need an explanation for a specific transaction or an updated document. Respond to these requests as quickly and thoroughly as possible. A delayed response can delay your closing, and in a volatile interest rate environment, a delay can even cost you your locked-in rate. Surviving the underwriting process is all about preparation and stability. You present a clean, organized, and verifiable financial picture, and then you hold that picture perfectly still until the finish line. You've proven your character with your credit, your capacity with your DTI, and your collateral has been confirmed by the appraisal. You've avoided all the last-minute mistakes. The underwriter stamps your file, approved. You get the email you've been waiting for. So what happens in the 24 hours after that approval? How does the money actually get to you? And what are the smartest, most strategic ways to use that new capital without digging yourself into a financial hole? That final crucial step, from funding to responsible repayment, is exactly what we're covering in the final part of this series. The funds are in your account. The number on the screen is real and it's big. It's a moment of incredible potential, but it's also a moment of incredible risk. This is the crossroads where financial futures are made or broken, because tapping your equity isn't the finish line. It's the starting gun. The choices you make in the next few weeks will determine whether this was one of the smartest financial moves of your life, or a mistake that will follow you for years. So let's draw a line in the sand. Every potential use for this money falls into one of two categories: the path of investment or the path of consumption. One builds your wealth, the other drains it, and the difference is everything. Let's start with the path of investment. This is where you use your home's value to create even more value. The number one classic example is strategic home improvements. And I use the word strategic for a reason. This isn't about funding your dream of a backyard water park. It's about projects with a proven return on investment, or ROI. Think about it this way. You're taking money out of your home's left pocket and putting it back into its right pocket, with the goal of making that right pocket even bigger. Data from across the real estate industry consistently shows that kitchen and bathroom remodels offer the highest ROI. A modern functional kitchen doesn't just improve your daily life. It's often the single biggest selling point of a house. The same goes for updating a dated bathroom. These are the workhorses of home value. On the other end of the spectrum are highly personal, luxury projects like swimming pools or elaborate home theaters. While they might be amazing to have, they rarely add as much value as they cost to build. A potential buyer might not want the hassle and expense of a pool. So the rule is simple. Invest in updates that have broad appeal and directly increase your home's marketability and core value. You're not just spending money. You're reallocating capital within the same asset to make it stronger. The second major road on the path of investment is debt consolidation. This is one of the most powerful and life-changing ways to use home equity, if done correctly. Millions of Americans are being crushed by high-interest consumer debt. Credit cards with rates of 20, 25, even 30%. This kind of debt is a financial emergency. It's like trying to fill a bucket with a massive hole in the bottom. You keep pouring your income in, but it just leaks out as interest payments. A home equity loan, or HELOC, allows you to take lower interest, single-digit rate money, and use it to completely pay off those high-interest debts. You're essentially swapping a dozen leaky buckets for one solid steel pail. The psychological relief alone is immense. Instead of juggling multiple due dates and soul-crushing interest charges, you have one single manageable payment at a fraction of the interest rate. This move can free up hundreds, even thousands of dollars in your monthly cash flow. But here's the critical discipline check. Once you pay off those credit cards, you cannot, under any circumstances, start running up balances on them again. You have to cut them up, lock them away, or change your habits. Otherwise, you haven't solved the problem. You've just given yourself more rope to get tangled in. The third investment path is funding an opportunity. This could be paying for a college education, or a specific certification that will dramatically increase your earning potential over your lifetime. It could be seed money to start a small business you've been planning for years. In these cases, you are betting on the most powerful asset you have, yourself. You're using the value of your physical asset, your home, to invest in your human capital. This is a calculated risk, but it's a risk aimed squarely at future growth. Now let's talk about the other path. The path of consumption. This is the danger zone. This is where you use your home equity to fund a lifestyle, not to build a future. It's buying things that lose value or experiences that are fleeting. The number one temptation is the luxury purchase. The brand new car, the boat, the round-the-world trip. Let's be brutally honest about what's happening here. When you use a home equity loan to buy a new car, you are trading a piece of an appreciating asset, your house, for a rapidly depreciating one. That car will lose 20% of its value the second you drive it off the lot. In 5 years, it might be worth less than half what you paid. But the loan on your house? That will still be there. You have effectively sold a small piece of your home to buy something that is guaranteed to become worth less over time. It's a wealth-destroying transaction. The same logic applies to a lavish vacation. The memories might be priceless, but you are still putting a lien on your home, your family's primary shelter and financial bedrock, for an experience that lasts 2 weeks. A much smarter way is to use the cash flow you saved from debt consolidation to budget and save for those things, earning them instead of borrowing against your future for them. But the most insidious trap on the path of consumption isn't the big, flashy purchase. It's the slow drip. This is when a homeowner gets a home equity line of credit, a HELOC, and starts treating it like a debit card. A dinner out here, a new gadget there, covering monthly bills when things get a little tight. Each transaction seems small, but they add up month after month, year after year. Before you know it, you've borrowed tens of thousands of dollars against your home just to subsidize your day-to-day spending. You've turned your greatest asset into a slush fund, eroding your net worth with every swipe. This is how people wake up 10 years later, with home values having risen, but with their own equity back at zero, having nothing to show for it but a decade of receipts. So, you've chosen the path of investment. You've used the funds wisely. Now comes the final non-negotiable step, a rock-solid repayment plan. The loan isn't free money. It's a debt that must be repaid with discipline. First, never ever just make the minimum payment, especially on a HELOC. Many HELOCs have an interest-only draw period for the first 10 years. If you only pay the interest, you're on a treadmill. After a decade of payments, you'll still owe the entire principal amount you borrowed. You've made zero progress. Your goal must be to attack the principal from day one. The best way to do this is to automate your success. When you set up your loan payments, calculate what you need to pay each month to have the loan completely paid off in a set amount of time, say 10 or 15 years. Then, set up an automatic payment for that amount, not the minimum. Make it a non-negotiable part of your budget, just like your primary mortgage. Treat this new loan with the seriousness it deserves. If you consolidated debt, take the total amount you used to pay on all your old credit cards and bills and point that entire fire hose of cash at your new home equity loan. You were already used to that money leaving your account. Don't absorb it back into your lifestyle. By redirecting it, you can pay off the loan in a shockingly short amount of time, saving yourself thousands in interest and rapidly rebuilding the equity you just used. Over these 10 parts, we've journeyed from the very definition of equity to the intricate details of accessing it and the profound responsibility of using it. We've seen that home equity isn't just a number on a statement. It's the physical manifestation of your hard work. It's every mortgage payment you made on time, every improvement you sweated over, every year you spent building a life within those walls. It is a powerful financial tool, forged from discipline and time. It is not a lottery ticket. It is not a piggy bank. It is a lever. Used correctly, it can lift you to new heights, a debt-free life, a more valuable home, a brighter future for your family. Used carelessly, it can drop you into a hole that's harder to climb out of than the one you started in. Your home is likely the single greatest financial engine you will ever own. You've worked hard to build its power. You now understand how it works. You have the keys. The only question left is, where will you drive it? Choose your destination wisely.